Hey, good morning, everybody. Corey Schrader, Black Creek Wealth Management. Hope everyone's doing well. Wanted to definitely get in front of you, especially this week, given that there's so much economic and just there's a lot of data that's going to be coming out this week. And the biggest thing I wanted to make sure that you are aware of is number one, obviously, I'm making sure that I'm really focused in on what is the theme this year? If you've taken a look at the markets have absolutely rebounded um, in some interesting areas. And I want to make sure that you're aware of kind of what I'm thinking. I've been talking with a lot of pension fund managers, getting some insight into what they're thinking, as well as, what is it that we need to be focused on? Because again, this week is a huge week. We have the Fed that we'll be talking about raising rates again. How long are they going to do it? Longer. Higher for longer, as they continue to say. There's a huge disconnect right now between the timing of what the market thinks is going to happen and what the Fed's going to be doing. So, wanted to talk to you about that. And also, you have an oil OPEC meeting this week, as well as you have a huge amount of tech earnings and S&P 500 earnings. So, there's a lot of things going on this week and just wanted to give you a little bit of an update. Again, not going to take too long, but I do want to make sure that I do go over a couple of notes and things that I've been thinking. So, the biggest thing that I really want us to kind of look at again is how can we navigate this as best as possible, right? You look at the market, you kind of get excited, you're like, oh, I could be kind of missing out. I want to talk to you a little bit about it. So the themes that I have this year is really slow and steady and trust but verify, right? So when we look at why is the rally, what's going on? Um, if you were to really dig down, and I have been digging down into this, a lot of the positions that have been taking off here is just the oversold positions have really been in focus. So your heavy tech names, your high discretionary names. Um, a lot of those were due to tax loss harvesting, more of a rebound effect. There's some anomalies out there called a January effect, if you ever want to take a look at that. Really, the leaders of the old regime, the tech, the consumer discretionary, those are the ones that have absolutely been outperforming, right? Especially in the first 3 weeks. Um, one of the biggest challenges that they have is they have tremendous headwinds with higher rates, slowing economic growth. The rally is predicted on the Fed pausing the rate hikes this week and talking about even reducing rates by the end of the year as a slowdown kind of starts to work into the economy by the end of the year. That's a huge assumption by the stock market people, right? Um, to say that the Fed's going to all of a sudden just say, you know what, we're just going to pause and wait. I again trust but verify, right? So it really begs the question to me: why are people really digging into the tech and consumer spending on non-essentials? Um, if we truly believe that the market is going to be slowing down and we're going to have some sort of growth recession, earnings recession by the end of the year, and the stock market leads by 6 to 9 months, are they already factoring in that all is well on the horizon, that the market's going to be dropping? If that's the case, the bond market is signaling a rate decrease due to that potential recession that's going to be induced by the Fed by them raising rates here. So why would investors focus on growth right now when it comes to these huge headwinds, right? Who's lying here is what I would say. Is it the Fed? Is it the market? Um, you know, Many times if you've been investing just for over the decades, you've probably heard at nauseum, don't fight the Fed, right? So where is the truth and what should we be expecting this year? Because it is one of the most challenging markets. We have not seen anything like this since the 70s, number one, but also they didn't have the type of what's the best way to put it? You can get in and out of things so quickly these days that the markets have changed. The dynamic has changed. So you could be caught in this tornado, this whipsaw reaction. And my hope and my plan is to really empower you guys to know that we are staying the course. Okay. And we are going to make sure that we are protected. And we are going to talk about that here in a second. So my focus is on the data and the Fed. Okay. So far, the data is coming in good with inflation easing over the last couple of months. Okay. Let's talk a little bit about that. So, what they're focused in on is really the rate of change of inflation, right? The Fed has a mandate of keeping unemployment as low as possible, as well as keeping inflation at 2%. Now, is that 2% on goods and services? Is that 2% on the rate of change of goods and services year over year? What does that actually mean? Well, in the broadest sense, they want to keep inflation or the price changes year over year at about 2%. Well, the rate of inflation has been absolutely been coming down. It was up 7%, 6%, now it's down to 4%, and even hinging on almost 3%. So the rate of inflation, or that change year over year, is coming down, which is great. Okay, the Fed's happy about that. But inflation, price inflation, if you were to go to the supermarkets, it's still way up there, right? Look at eggs, look at milk, look at really anything. So prices have absolutely come down. So is the Fed really want to look at the mindset of price deflation or price disinflation, where we want to get prices back to where they were a couple of years ago, right? And if that's the case, what has to happen? You have to have a negative inflation rate. Is that what they're thinking? Kind of where my mindset is at, right? They don't want to see the reemergence of inflation. Again, the stock market is going up. Last year, good news was bad news and the market would drop. All of a sudden this year, good news is good news. And hey, the party's back on. Let's rally. So, what is the truth? Again, we want to watch out for that. What happened in the 1970s? And they've already asked Powell this. When I say this, I mean the Ways and Means Committee and the Financial Committee. They've asked Powell, if you have to throw a basically napalm on this economy and do what Volcker did back in the 70s and raise rates up to the 20% number, will you do it? Without pausing, he said, absolutely. If I have to do it, I'll do it. So, what is his mindset? His mindset, maybe he was lying to us, maybe he was tongue in cheek. Oh, yeah, we'll see what happens. The truth is he does not want to see a reemergence of inflation. And if the economy heats up, again, the last 2 weeks, we've seen the lowest unemployment and initial jobless claims that we've seen in the longest time. So the job market is absolutely hot. People are still short labor. People are still making money. Stock market's up again. What is he going to do to try to throw a cold, wet blanket on this economy, right? He doesn't want it overheated. So he wants to keep inflation at bay. He wants to keep unemployment. And what he's going after now is, how do I remove people from the workforce? And that's what he's focused in on. So the way to do that is to choke these businesses. And if you look at earnings and you look at their guidance, they've been cutting jobs left and right. Now, they may be absorbed by other companies, and that's probably what's going on to some degree, but eventually this will stop. So in his mind, if I go ahead and I choke out the economy, raise rates, cut this over excessive world, which we really do need to do, how is that going to play down, right? So, as I said, his focus right now is unemployment. This jobless claims numbers have to get worse before I believe he's going to take his foot off the throat of the economy. That's my thought. So as we move on, let's talk about this market, right? So to say that the market is hotter than a South Florida road during the summer and that it's way over its skis is an understatement, okay? At the end of the day, this market is wicked hot. And again, it's all predicated on, oh my gosh, the market, and I say the market, let's look at the top 100 technology companies. It's up almost 12% year to date in 3 weeks, okay? The thought of fear of missing out is prevalent. It is absolutely out there, but is it retail investors? Is it the institutional investors? I would tell you that a lot of institutionals, just like myself, are looking at it from the lens of trust but verify. The Fed has said they're not going to cut. They're not going to play this game, and the market is trying to time it. In fact, there's the biggest spread between what the Fed has said they're doing and what the market believes they're going to do. Just in history right now. So momentum and short-term traders are absolutely running this thing up. This is why I've been ad nauseum telling people trailing stops, have an exit point. If you're doing, an individual stock and you're selling covered calls, you pay attention to those things because those are what you're going to be able to take advantage of. Again, we have a huge tech earnings that are coming out. S&P 500 is coming out with their earnings estimates and such this year, this week. So right now it's trading at about 18 and a half times earnings. Typically, overheated would be somewhere around 20, 21. Earnings estimates are still coming down. So all that's going to affect where we need to go. My mindset is still, I believe we're going to see 37, 3,600 on the S&P 500. We're at 40 or basically 4,000 and some change right now. So that's a little bit of a drop from here. So what do I think is going to happen this week? Well, the bull case is the Fed pauses and everyone rejoices, right? The people rejoice and everything's great and wonderful. And, okay, I was a little bit defensive. We got a little bit more of a dividend paying. I shift a little bit more towards the growth. We start basically riding the wave from here, okay? The neutral case is the Fed continues to raise, hikes for a little bit longer, indicates we're going to wait and see, basically keeps the market at bay. And then, of course, the bear case is hey, we're going to raise 50-50, and then we're going to go higher for longer until this wage and labor stuff gets unsticky and it needs to come down, and basically get us back to that 2% number where we're so above the target rate that it starts sucking prices down because you start seeing deflation in prices and people wait for prices to get lower before they purchase. And then there's that basically price spiral down. And of course, there is a level of stagflation that comes with all of this. And at the end of the day, they do not want to see that. So where do I think we'll end up? I think we're going to see more of that neutral case. They're going to still say, hey, we're going to be hawkish. We're going to continue to raise rates. We're going to wait and see by the summer, maybe do one or two more up until March. By April, we'll kind of see what we're going to do. I don't think it's going to be necessarily this dovish mindset of, hey, we're just going to, not raise any more and just see what happens. One thing I'm not even talking about is quantitative tightening. And what that is the Federal Reserve has stopped purchasing bonds. They basically haven't been doing this for a while. So they're trying to reduce their balance sheet. And if they're doing that, and from what we've also been seeing is China stopped buying our bonds as well. So you have all that liquidity that is just getting sucked out of the system. So who's going to be buying all this? Who's going to be providing liquidity to the United States? We haven't seen that happen yet. It's like watching Muhammad El-Arian was talking about today. It's like watching paint dry. We have no clue what's going to happen with that. So to say that we're in the all clear, not overly excited about. So again, I'm back on this trust but verify, slow and steady. One of the other things that we really haven't even talked about is you go back 10 years and even the last 10 to 12 years. That brings us back to 2010, right? What was interest rates back then? Basically zero. You couldn't get paid for anything when it comes to cash. Cash right now pays about 4%. So the risk-free rate is relatively high. So if your bogey, and we did this through planning, and we've determined that your bogey was about 4% for you to basically retire, everything was kosher, and you can get 4% in cash right now, why are you doing anything else but that, right? Well, on the high end, they were saying that the stock market, they expected it to be up about 15% returns by the end of the year. Average estimates right now are coming in at about 5 to 7%. And the S&P 500 right now is at 6%. Okay, so how are they so far off? It's because there's just no clarity right now. So the way that I look at it is, okay, let's say you had a 50-50 portfolio and 50% of it's in cash and you're getting 4%. That's 2% that you're getting from that. That means that if the market goes up to 10% and you're getting 5% of that from stocks, you've just cleared 7% with half of your money in cash, right? And if your bogey is, let's just say 6 to 8%, and you've hit your 7% number and you've sat out of all this whipsawing, and instead of us heading into 7, 10, 15 foot waves, we're only in 3 or 4 foot waves. And it's basically we're calm and steady while everyone else is going like this and getting seasick. That's my focus this year. Is if your bogey is 7%, if it's 8%, if it's 10%, I'm going to capture as much of that as I can do using cash as kind of our more stable, secure. Of course, I want to see us get as high of a return as we can, but I'm not putting risk outside of what your tolerance is. I'm not going to just put risk to the side and just say, hey, let's just go for full returns, because to my mindset, I still believe that we have a lot of rockiness to come. So I want to make sure that we are doing the right thing. We're trust but verifying. We're slow and steady this year. And as of right now, we're right around 2.5% holistically across everyone's strategy. Some of them are higher, some of them are a little bit lower based off of where you're trying to get to. So that is why right now I'm doing what's called fading into strength or selling into strength when it comes to this market, because again, there is going to be a little bit of a pullback, and I don't want to forego or give up the gains that we've already seen and ride this wave. So I'm actively on it. I'm actively managing it. Okay. So again, I'm not 100% set on this opinion, in the sense that if, it doesn't go the way that I think it will with the Fed this week, that I'm just going to, just stick to my laurels and, I will be proven right. No, if the market changes and the sentiment changes and momentum changes and the Fed's all of a sudden this, we're going to go ahead and just let it happen and just not raise rates for the rest of the year, I'm going to pivot right away. And I already have a strategy in place ready for that to happen. So, again, the biggest thing that I want you guys to know is I'm on top of it. I'm making sure that I'm actively on top of it this week and making sure that I'm keeping the gains that we have and really just focusing in what is the risk, what is the return that we're really shooting for as a firm and as an individual per your plan. I am making sure that I'm keeping your risk as low as possible this year and really making sure that I'm following what we need to follow, reading the charts, reading the waves, reading just these markets and this momentum, and making sure that we are staying level-headed through this right now, because it is going to be a challenging year. It was a little bit challenging last year. We did really well. We outperformed last year. I want to keep that outperformance this year and build on that for you. So again, I'm really wanting to dial in on your risk and return this year as we go through our annual reviews from last year and talking about what are we focusing in on this year for our reviews. If we need to set up another conversation and circle back on this, if you have any questions, concerns, thoughts, if we have already met, if we haven't met, this is what we're going to be talking about. But I really want to make sure that you're taken care of and you really have a good partner this year as we look to make your situation better. So again, I really appreciate you allowing me to take some time with you here. If you haven't set up a meeting with me and you want to, please, 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 let's set that up. As always, if you know somebody else who's struggling out there that really needs help, that you believe will benefit from a one-on-one partnership with me to really make sure they're taken care of, please, please, please don't hesitate to let them know about me, because I really want to make sure that our community is taken care of and that you are taken care of. So again, have a blessed week. I'm really excited about this week. It's not all bad news. Everything is great. So continue to enjoy your retirement, continue to enjoy those things that you love to do, because I love to make sure that you are out there playing while I'm paying the bills. So have a great day. Talk to you soon. God bless.